Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time.
In this week's episode of the FIN-LYT podcast by EWA, I'm joined by Ben Ruttenberg. Ben has the pleasure of working with specifically a lot of really young physician families. So, a lot of specialized physicians that are in their first contract, just starting attending after residency. And so today we're going to talk about risk management planning and why it's important for young family specifically. So Ben, thanks for joining us. This will be a fun conversation.
Thanks for having me. Looking forward to diving in here. This is a super important topic and there's a lot of different perspectives out there. So I think it's important to get our philosophy out.
Yeah. I think so. I want to give a quick backstory. This is a really widely, I guess, controversial, polarizing topic in the industry because you have there's really, in my opinion, two ends of the spectrum. You have I don't even want to say advisors, more agents that talk about insurance planning only. And then you have investment advisors that say that, investments are the solution to every problem, and they neglect insurance planning. So we really take an approach of marrying the two. And, insurance planning is not part of your investment planning, and investment planning is generally not part of your risk management planning. So one quick backstory, and this actually is a lot of this is why we started the independent RIA. Ben and I and majority of our team came from a large insurance company, broker-dealer before. And within this culture of this insurance company, broker-dealer, it was risk management planning was the focus. Everybody we sat down with had to have risk management planning, which they should have it on some capacity, but it was so oversold. It was the solution to every problem. And so one quick backstory I want to tell, I remember I was in a training, this 4 years ago, and the managing partner of the office, we were going through a case of a young family, and he had recommended a lot of insurance. And I had asked the question, why would we not fund a Roth IRA first? And he said, well, insurance is based on age and health, which is true, but you can fund a Roth IRA on your deathbed, was the exact quote. And that a light bulb went off. And that was just side note when I knew I shouldn't be there. But that's just an example of in our opinion, which we're going to dive into, we want to fund all of these tax efficient accounts first, and risk management planning is risk management planning, meaning it is there for a death benefit or for disability insurance. It's insurance. And in this scenario, the general agent was recommending a bunch of whole life insurance as the solution instead of a Roth IRA, which in our opinion is just so incorrect. And we're very passionate about making sure that this is done correctly. So that's just kind of unfortunately what a lot of the industry still does. And so Ben, talk to us a little bit about risk management planning versus investment planning, the differences, how they fit into a plan.
Yeah, and really quick, before we dive into that story that you just told is, pretty crazy, and it's one end of the spectrum talking about kind of the insurance side of things. But like you said, there's really two extremes on the pole, so to speak. One of them is kind of the insurance agent, and the other one is the investment advisor. And oftentimes I'll see investment advisors talking to clients that don't have any risk management planning done, and the full extent of their review meetings or their quarterly reviews is quite simply talking about portfolio moves, the cost of the portfolio, weighting in certain sectors, and things like that. So what we try to really stress upon clients is that's equally as bad, because a mentor of mine, taught me this when I was very, very young, and it's really stuck with me, is that an investment account is not a financial plan, just like an insurance policy is not a financial plan. So everything does need to be coordinated in one picture. And if you could have the best investment strategy, be fully asset allocated, diversified, plan on not using the money for a really long time, be in low cost funds, you could be doing all the right things from an investment standpoint. But if you don't have the proper risk management planning in place, and there's a death or there's a disability and you're not prepared, it's not going to matter that you had this great investment strategy because it's all
ruined.
The plan's ruined, and it's all coming back out anyway because you need to figure out how you're going to live your life moving forward. So totally agree with that, and that's why it's so important to marry investment planning with insurance planning, doing it the right way, and especially with young families, it's something that does need to be addressed sooner rather than later.
Yeah, no, I couldn't agree more. I think that, marrying all this stuff, looking at a financial plan holistically is like, obviously in our opinion, we're super biased. This is what we do, but that's the best approach. And there's no really other way to do it. So let's talk about risk management first. Couldn't agree more. Done properly with the caveat again, that should be the first thing you do. So let's just look at when we break down fundamentally risk management planning. This is like, how do we mitigate anything that could happen? So if we're talking about a young family, we work obviously with a lot of physicians. So we're going to talk through like a physician in residency signing that first contract, and now they're making real money, and what type of stuff they should have in place. But risk management planning just fundamentally is life insurance, disability insurance. Obviously, there's some like property and casualty insurance that we could talk about too, home, auto, umbrella, all of these things, making sure that like if there is a huge risk, something happens, that this stuff's covered and that this insurance pays out. So Ben, let's talk about let's just talk about let's just say a physician's in residency. And so just if you don't know, a physician in residency or fellowship, they're going through undergrad, they're going through 4 years of med school, they're going through probably 4 years of residency, give or take, and then maybe they're going through fellowship after that. So at this point, they're in, as they're going through this, let's say you graduate undergrad at 22, you graduate, if you go right into med school, which a lot of people don't, that you're 26, and then 4 years of residency, you're 30 years old, and then if you do fellowship, like you're in your 30s already.
Right.
And you're not really making money all through that. You don't make money in med school, you're just taking on loans, and then in residency fellowship, you're making like 50 grand a year. And then you sign your first contract depending on your specialty, and you could go from making 50 grand a year to 500 grand a year. So let's talk about a physician in residency. What should they be thinking about first? And then we'll transition into them being an attending, signing their first contract.
Yeah, no, that's a great point. And like you said, this is probably making somewhere around 50 to 60,000 a year. So there's not a lot of disposable income in the budget. Oftentimes residents have a rent payment, maybe have a student loan, income-based student loan payment, and they're just trying to make it work until they become an attending. So from a risk management standpoint, again, all of this is based on your age and your health. So the younger you are and the healthier you are when you apply for life and disability insurance, generally speaking, the better the rates are going to be. So if you're a resident, I would say things to think about. Again, this is so individualistic and specific to your situations, but generally what we're seeing is trying to get the most amount of disability insurance, supplemental disability insurance that you can while you're in residency.
And generally, so as a resident, the max that they'll give is $5,000 a month. And so if we break that down, if you're making 50 and you have group coverage, they'll pay you 60%. That, you're used to living on like $3,000 a month probably. And that group policy after taxes may pay you $1,000 to $2,000 a month. And so they wouldn't qualify for $5,000 a month because they're not making that much money. Mm-hmm. But these insurance companies know they're training to be a physician, their income's going to go up, so they'll give them that full $5,000 before they qualify, which is like a huge benefit.
Right. And not to get too down a rabbit hole, but what you just said is a common objection that we'll often hear from people when we talk about risk management planning is, I have it through work, whether it's life insurance or disability insurance. And what you just outlined is so true. Oftentimes with workplace disability insurance plans, they will cover 60% of your base salary, may or may not be covering any bonuses. So if you're a physician and you've got a big kind of bonus compensation structure, it's something to really look at in your contract. And also if it's employer paid, which most employer disability insurance plans are, that benefit that you receive is taxable, and depending on your income rate, that could be as high as 37%. So walk through that and kind of the implications for what that means.
Yeah, just say let's just dive into disability while we're on the topic. So basically, if we think about like that that physician example, you're taking on, okay, so if you have undergrad debt and then you have med school debt, like that could be generally is anywhere between like $200,000 to like $500,000. Obviously, if you have both, closer to 500, could be anywhere like 200. So if we think about it, you're taking out debt, you're leveraging debt to train to be a physician. Generally, that's a good trade-off because you come out making a lot of money. And so what the one risk that could happen other than dying is you get disabled. And so you've taken out debt, you've learned to become a physician, you have all this income ahead of you, let's say $500,000 a year for 20 years, however, like that's a huge number of income. That's a huge number. That's just your biggest asset.
Right.
And so if you get disabled, you no longer have that. And that's what disability insurance covers that. It's like you are literally covering your income that you just spent all of this time and money and effort training for.
Sure.
So while you're in residency, no brainer, you should get as much disability as they'll sell you. And it is a cost. It'd be, probably $200 a month max, but like not even a question you should do. And so if we think about too, another component of that on the student loan example is student loans. Let's just focus on disability and then we'll talk about life insurance, what happens if you die. But student loans, right now there's public service loan forgiveness, which is a 10-year program where if you are employed by a nonprofit, which a lot of hospitals are, after 10 years of payments, the loans get forgiven. A lot of physicians go that route because if we just think about it, for the 4 years of residency can count. If you do any fellowship, maybe there's a year or 2 years or another 4 years that could count depending on a specialty. So by that point, you're over halfway done. And it's like, okay, now let's just work at a nonprofit for a few years, get these forgiven. Ben, what happens if you get disabled and you're not working? What happens to your student loans?
Right. So that's a huge consideration that not many think about. So the whole purpose of being on public service loan forgiveness is that you're actually working and you're able to make qualifying payments while you're working at a nonprofit. So you could go down that path, be at a nonprofit, and then if you get disabled, you're no longer working. Those payments then no longer qualify for that loan program. So again, making sure that you have disability insurance in place to supplement against that risk is so important, especially if you're going to be banking, your short to midterm intermediate future on pursuing a nonprofit for the purpose of getting those loans forgiven. You need to make sure that you're actually going to be able to qualify for making those payments.
Because if you're disabled, you're no longer employed by a nonprofit. Therefore, you're no longer making qualified payments because you're not employed, and then you have to pay back all of your student loans, which could be like a $500,000 swing. So that's like we cannot hone enough how important that is. That like disability insurance, especially primarily if you're in a occupation where you've done training and schooling and you have a high income, as like the first thing you should do, no matter what, like buy as much disability insurance as you qualify for, especially if you're a physician. So get it while you're in residency. And then that's generally one of the first things that we recommend if we're working with a attending in their first contract and they haven't done that, it's like, this is the very first thing we should do. So let's now talk about, this would be a good segue into, well, actually, no. While we're on disability, let's talk about own occupation versus any occupation. So you can get we're not going to get too granular just for the sake of like, it's kind of boring and dry. But if you analyze these disability contracts by each company, there's different definitions. And so own occ, especially in the medical profession, is really important. So Ben, what does that mean?
Yeah, so really two types of definitions that we need to be aware of when we're applying for disability insurance. One is own occupation, and the second is any occupation. And it's a one-word difference, but means a huge amount when you're actually going to be receiving disability insurance payments based on what you qualify for or what you don't qualify for. So let's break both of those down. The less stringent definition is any occupation. That's something that we try to avoid for disability insurance contracts. So let's say, for example, you have a cardiovascular surgeon that specializes in what he or she does and gets disabled. If their disability insurance policy is any occupation, it would cease payments when they could do any gainful employment. So not necessarily going back to being a cardiovascular surgeon, but if they could
work at
Walmart, for example, or if the insurance company decides they could, do research and, earn a fourth of what they were making as a surgeon, then disability insurance payments would stop. And so it's really important that when we're looking for disability insurance, we're looking for medical own occupation. So in that same exact example, you have a cardiovascular surgeon they get disabled. If their definition of disability is medical own occupation, the actual disability insurance payments will continue until he or she can go back to doing their duties as a surgeon. So it doesn't matter if the insurance company thinks they could do research, or they could be a professor, or they could work at Walmart, like you said, until they can be a cardiovascular surgeon again. That is when they could then meaningfully go back to work, and then the payments would stop.
Yeah.
So really, really important definition.
And nothing wrong with working at Walmart, but that's a huge jump from like cardiovascular. You could be making $1 million a year to like minimum wage.
Right.
And that's legitimately, we wanted to use an oversimplified example because like the insurance company would say, well, you can make, like you are not disabled enough to earn a minimum wage job.
You can do a occupation.
Yeah.
You can do
and so
any
we're not going to pay
occupation.
you this benefit. Whereas not to get too granular in the contracts, but like there are some contracts where it's like if you're making $1 million a year as a surgeon, you get I don't even know what an example would be. Something happens where you can't do surgery, or maybe you're not able to do the volume you were doing, so you cut back to like 50%. So now based on your production, you're making $500,000. Well, this policy could still pay out and pay you, on top of what. So basically, if you're doing half the amount of volume that you were doing, you're making half the amount of money, this policy would pay you on top of that to get you close to where you were before. Whereas any OC would not do that.
Right.
So especially as a physician, the definition in the contract is so important. And all these companies have different definitions and different ways they pay out. We're not going to get into the specifics of it, but just make sure that if you are analyzing a disability insurance contract as a physician, that you really understand how all these companies work, what they pay out for, what they don't pay out, et cetera. Super important. Anything to add on disability insurance before we jump into life insurance?
No, I think for residents that hits on everything you need to hear, is getting the maximum amount you can while you're in residency, while you're as young as you are and as healthy as you are, and then making sure that the definition is medical and occupation.
Yeah, couldn't agree more. So let's play out this example then. We'll say we have a second year attending physician family. So husband, wife, 2 kids, we'll say, for example. And so they've gotten the disability insurance in place, and we're sitting down with them to do a financial plan. Let's talk about life insurance. Super polarizing topic in the industry. Just in my opinion, kind of like the story I told at first, it gets oversold. A lot of agents think that it's the solution to all problems. So when let's just use this example. Ben, talk about like what is the difference between term life insurance and then, there's whole life, universal life, variable life insurance that's not just an insurance coverage.
Mm-hmm.
It has some sort of account component that grows that you could access. But let's first talk about the difference between the two.
Yeah, no. So really important to understand they're very different and they serve very different purposes. Generally speaking, for our conversations, any sort of universal life or variable life product is not going to be part of a young family's recommendation. Very rarely do we recommend that, maybe for a super, super specific situation. 99.9999% of the time, it will not be applicable to what you're doing. So back to what you're saying, term insurance, think of it like an analogy that I like to use to help kind of understand it is term insurance is like renting an apartment, whole life insurance is like buying a house. So term insurance, as the name suggests, is insurance for a specific term. So whether it's 20 years, whether it's 30 years, some companies will go to a certain age. So like term insurance until you're 70, term insurance until you're 80, so on and so forth. It works very similar to, homeowners insurance or car insurance. It's use it or lose it. So if you pay a monthly premium every month, and again, let's assume it's a 20-year term insurance policy for $1 million. You pay premiums for 20 years, and if you don't die within that 20 years, you don't get $1 million payout to a beneficiary. And then if you basically, once the policy ends in 20 years, you have nothing really to show for it. So there's no equity component, there's no cash value.
So that's the first thing, is we want to make sure that the life insurance is for a death benefit. I cannot stress that enough. There are other uses of life insurance, but the primary reason you buy life insurance is to have a death benefit.
Right.
So if let's play along this young physician family making $500,000 a year. First thing we want to do is let's, at a bare minimum, make sure that you have the right amount of term insurance in place. So 2 components how we judge this and we base this metric. So the first, like, back of the napkin rule of thumb is 10 times gross income. So if you have, let's just use the example of one working spouse. The working spouse is making $500,000 a year. Generally, we want a total of $5 million. And the second test is we use an acronym called LIFE. And that generally those 2 work out to about the same. If we check every box on the LIFE acronym, it'll get to about 10 times gross income. So Ben, let's start there. What do people want covered? What does LIFE mean?
Yeah. So generally speaking, we have these conversations with clients all the time, and they're super individualized, but at the same time, it all kind of comes back to a lot of the same philosophies that clients want to make sure are covered if something happens. The first one, again, that L in that LIFE acronym is liabilities. So making sure the mortgage is paid off, making sure student loans are paid off.
Let's talk about that for a second.
Yeah,
if the private student loans, so if someone dies, if they're private student loans, somebody inherits them. Mm-hmm. So if $500,000 in private loans, other spouse has to pay them. If they're federal loans, they're gone.
Right.
So that obviously wouldn't need covered in life insurance. But so liabilities. Okay, now what's the I?
Yeah, and this is super variable and super dependent on your family situation, but I is income replacement. So a lot of times this is actually could be, depending on the scale, number. This could be a huge swing in the actual death benefit amount, but depending on lifestyle, depending on how long you want to make sure that this income is lasting, depending on how old you are, making sure that, again, if this example, we have a $500,000 working spouse and the other spouse is not working, we want to make sure that the family is able to maintain the same standard of living when the working spouse was alive and providing the income. So whatever that number tends to be, we just want to make sure that, again, based on budget, based on cash flow, that is sustaining their current lifestyle.
Yeah, I like to just, it's kind of morbid and people don't like to think about it, but we pride ourselves on, we have tough conversations that people don't think about and honestly don't want to have. But if I say, like, I'll just say, hey, let's just play this out. Or if, like, one of you passed away, if the working spouse passed away, like, other spouse is either going back to work, probably if they're not a physician in this example, they're not going to make as much money. So, they're going back to work, but then who's taking care of the kids? So it's like, what would need to be in place on a monthly basis to actually replace that and make sure that lifestyle, exactly as you said, is taken care of. And so if they're 35 years old, probably needs to be in place for 30 years, and that could be a huge number. And there's 2 ways to figure that out. You could literally just reverse engineer that, come up with that number, or whatever they need, you just take a lump sum and then take the 4% withdrawal rate. So if, oversimplified example, if they needed $40,000 a year, which is a super low number, $1 million into an account, spitting off 4% a year would pay them that $40,000 forever. So that's couple different metrics we can use to calculate that. But basically, it's just making sure monthly expenses are taken care of if something happened.
Yeah, and one more note on this before we finish out this acronym is that these are really uncomfortable conversations to have, but this is why we're in business, and this is our job to make sure that we're having these conversations. It's our opinion that if you're marketing yourself as a financial advisor and doing financial planning and you're not having these types of conversations with your clients, you're not preparing them for what could possibly happen, and you're in our opinion, you're not doing your job.
People want advice on things they're not thinking about. And so I just think about, like, who do I go to advice for on things? And I want them to tell me things that I'm not thinking about. And the same goes for clients. Like, they're not thinking about how much, especially if you're like a physician or you're a high income, you're really into your career, you're so busy in your day to day, you have a family, and, like, you're not thinking about, like, you're not sitting down and how much, life insurance do I need over the next 30 years on a monthly basis? So a huge value add, couldn't agree more, but let's go on to the next one.
Yeah.
F-E.
So F is final expenses. So
pretty
making sure that
but
funeral is taken care of, and then E is education. So making sure that, again, in this example, we had 2 kids. If you want to fund maybe 100% of a public school, that could be anywhere from $20,000 to $25,000 a year, depending on what state you live in. If you wanted to fund 100% of private school, that could be anywhere from $50,000 to $100,000 a year. So why don't you walk through?
Yeah, I was going to just go through an example here. So just actual numbers. So liabilities, let's say you have a $500,000 mortgage, and let's just say we're making $500K a year. So we'll just show you how this gets close. So 10 times income means total of $5 million of insurance.
Right.
That would be like the back of the napkin. But if we want to say, okay, let's actually back this up. So life insurance, let's just say liabilities are, let's say they're $1 million. So we have $1 million in liabilities. Income, if you're making $500,000 a year, you're used to probably spending about $23,000 a month. Let's say if the liabilities are paid off, let's say you need $15,000 a month for 20 years. So that's $180,000 a year times 20. That's $3.5 million. I'm rounding a bit. And then education for 2 kids, depending on private versus public, that's probably another $500,000. And so literally right there, we have $1 million for liabilities, we have $3.5 million of income, $500,000 of education. What does that equal? $5 million gets us right to that 10 times income. So that's basically how we figure out everything. Obviously, final expenses could be thrown in there, but that's like $30,000. It's just a small number in the grand scheme of things. But so that's basically how we figure out how much life insurance coverage somebody should have, and that's like, again, with a young family, I mean, that's the purpose of risk management planning. Like, it's not, like, that's the first thing that needs done. Mm-hmm. Anything to add? And let's talk a little bit about whole life insurance.
Yeah, well, yeah. So I guess the natural follow-up question is, okay, we've determined for this family's example, we need $5 million of life insurance coverage.
How do we do that?
What does that mean? Does that mean $5 million of term insurance, $5 million of whole life insurance? Why don't you walk us through?
Actually, that's a good point. So basically, if you think about the insurance needs, so let's just say a 35-year-old couple, kids are young, their insurance need right now is really high. And then their income, assuming their income goes up, the insurance need's really going to start to increase. But then it'll get to a point where high income earners, let's say mortgage gets paid off eventually, education's funded at some point, and then income is a smaller number because they've built up savings, and so that number to 65 that income would need replaced is much smaller. So as you progress through life, your insurance need is going to increase, but then it's going to drop off substantially. So they're not going to need that full $5 million until they're 65. That's just not realistic. So generally, what we'll like to do is layer it. And so if they need $5 million, we may do, depending on how granular they want to get, honestly. But term insurance, it's like we said, use it or lose it. Let's say you have a 20-year policy. If you don't die in 20 years, nobody gets any money. The insurance company wins. However, if after 20 years you still need insurance, you got to buy another policy. So we'll do something along the lines of, let's say the kids are 5 years old. So for the next let's say that for the next 15 years till the kids are 20 through college, if college is a goal, they need a lot of coverage in place. So of that $5 million, we may do something like, okay, $3 million of that coverage is going to be level term 20. And so that means for the next 20 years, you have $3 million. And then we're going to have a $2 million policy that's a level term 30. We like level because that means the cost never increases. There are certain types of policies that as you get older, that the health rating is locked in, but as you get older, it gets more expensive, which is like kind of defeats the purpose of doing it while you're young and healthy. So in this scenario, we'll say, okay, you have $3 million for 20 years. That's going to get you the kids through college. If the kids are 5, they're going to be 25. You could just drop that. 20 years from now, you're not going to need $5 million of coverage, most likely, generally speaking. So drop that. And then we have this $2 million policy that's in place till you're 30. If we don't have any whole life, we have the option now. We could keep that for another 10 years, or you just drop it, or you decrease it. But let's talk about generally what will happen, what we would recommend. And again, so specific, financial planning specific, case-by-case specific, but some of that will get converted to whole life at some point, and then you get to the point, let's say 20 years from now, you've converted some, you keep the whole life, and you drop off the term insurance, and that gives you enough coverage that you would need. But let's dive into whole life insurance. Like you said, what's the split? Primarily, the first goal is we want $5 million of coverage. Ben, first let's just talk about, so we're not going to get into variable or universal life. There's just specific examples like estate planning purposes, different things that you potentially would use that for. We're going to talk about just fundamental philosophy we have on how we position whole life insurance inside of a financial plan. So Ben, talk about, so you said term insurance is like renting. You're buying a death benefit if it's use it or lose it. What is whole life? And we're going to talk about specifically just a fixed cash value inside of a whole life insurance contract.
Yeah. So like I said, like you said, term insurance, renting an apartment, whole life insurance, like buying a house. So bigger monetary commitment up front with whole life insurance than traditional term insurance. But in return, you have coverage that lasts forever, which really important. So instead of a term insurance policy, like you said, that could last for 30 years or last for 20 years, as long as premiums are paid on a whole life insurance contract, that coverage will last for your lifetime. And in return for the larger monetary commitment up front, there is a cash value component that you could access at any time for any reason. And that cash, again, depending on the insurance company that it is with, grows with the general account of the insurance company's portfolio. So it's not correlated to the equity markets. And there are a lot of factors in play in terms of how you can use the money, and then if it's coordinated with your overall investment strategy, you can really get strategic with your overall asset allocation, knowing that you have safe money that is growing outside of the stock market inside of a life insurance contract.
So let's just like fundamentally the difference. So for you to get $1 million of term insurance as a young, healthy somebody in their 30s is probably what, $100 a month maybe?
Something along those lines.
And so then on the flip side, if you were to get $1 million whole life, this stuff's a lot more expensive. You'd probably be paying $1,000 a month. But number one, it's in place forever, like you said. So you don't have that death benefit, use it or lose it. Like it's there forever. And then the second thing is we have this cash value that exactly what you just said, grows not correlated to the stock market. Let's dive into that a little bit more, and then we'll talk about when and how we would implement this. So the cash value inside of a life insurance contract, basically how we look at this is it is the safe asset on your balance sheet that has contractual guarantees built in, and it cannot go backwards. So like you said, these insurance companies, actually, this is a cool side note. If you look at Warren Buffett, who people think is like the greatest investor of all time, a lot of his best investments are actually on insurance companies. Like he loves he loves investing in insurance companies. And the reason being is a lot of these insurance companies, they've been around since like the 1800s. It's like if you're a business that can last 150, 200 years, like you clearly know what you're doing. So these companies are very strong, very stable, and a lot of the mutual companies, they're not publicly traded. They'll pay out a dividend to policyholders. So there's no stockholders in the company. If there's profits, they'll pay them out back in the form of a dividend to the products that the policyholders have. And so a whole life policy, there's contractual guarantees. So if you buy $1 million of coverage on a whole life policy, you're funding money into it. This cash value is going to build up. Basically, if you look at the insurance ledger, if the company never paid a dividend, there's this contractual guarantee that like over the long course, you can't lose money. So basically what you put into it, the money in that cash is going to be more than what you put into it over the long haul. Plus you have the permanent death benefit. It's always higher than both. And so these companies, they're very stable. They have this big general account portfolio that's invested in a bunch of like safe stuff. Like 90% of it has to be in like fixed income, and then they invest in some stuff since it's such a large amount of money pooled together, like private equity, these real estate deals, stuff that like you and I can't put money into because it's billions of dollars pooled together. And so then based on these general account portfolios, super safe. There's a lot of regulation on like how these portfolios have to be structured because again, it's backing all of these insurance policies. And so they pay this dividend out. Historically, net of the expenses of the insurance policy could be like 4 to 5%. So again, we only want to do this with a select few mutual companies that are really good, but this contract could pay you, 4 to 5% after expenses back into the policy. And so that basically serves as like the safe asset on the balance sheet. So that's like similar to having cash or having bonds or fixed income. And we've talked about this before on the podcast, but 2022 is like the textbook perfect example because 2022 S&P 500 was down over 19%, and the bond indexes, the Barclays bond aggregate was down, I don't know the exact number, it was over 10%. It might have been like 13 or something. But generally speaking, bonds and stocks work inversely, meaning if there's a huge drop in the equity market, people flee to safety, and bonds generally speaking will hold their value. 2022 was like the most extreme example where like these things both went down. That like really has never happened. And so whole life insurance went up 4 to 5% still if you had a good policy. And so basically a year like that, that's where whole life fits in, is like, okay, if you ever need to take withdrawals, we don't have to worry about what the stocks or bonds are doing. You can take money out of this contract. We're not going to get super granular into how, but you could take money out without ever locking in losses of your investments. So that's basically, from a high level, how we position it on the balance sheet within the financial plan. It's like your safety net that you could access no matter what's going on. Because if these insurance companies failed, I mean, there's huge problems in the world and the economy. Because like I said, these things have been around for 150 years. They're safe. They have regulation that they have to, have these safe investments. Anything to add on that, Ben?
Yeah, and these are all backed by, again, like you said, policyholders that you have to medically qualify to get a life insurance policy. So if you are in really, really poor health, they won't accept your application. So they're receiving money from people that are going to live for,
are healthy. And
are healthy. They're not just taking anyone off the street that they're taking money from and giving money to dividends to.
Yeah.
There really are really strict insurance underwriting requirements to actually get a policy, which is why it's so important, like we said, to get it when you're young and healthy. Because oftentimes when people think that they need something like life insurance, they can't get it. So they're paying dividends to people that are very healthy, that are paying premiums. So totally.
And then also offer annuity products, which like we won't get into it, but like life insurance and annuity is like the perfect business model, because then you're insuring income and life, and so it just like basically adds like another layer of like, I don't want to say protection, but just like safety to the company's balance sheet. Okay, so that's great background on whole life insurance. Can fit into a financial plan, but we need to be doing other things first. So like we said, first thing, disability insurance, death benefit. Let's play along the example of the physician. I am going to make a very strong statement here. There are very few scenarios where a resident physician or fellow physician should ever own whole life insurance. I feel very strongly about that. I've seen so many times where residents and fellows are sold life insurance policies, and honestly, it's almost criminal in my opinion. So I want to make that statement very clear. There are exceptions, if they inherited money, they don't have any debt, maybe it could fit in at some point, but you should not have that while you're a resident. You should have term insurance and disability insurance. And Ben, explain why, and I think that'll just be a segue into like, what do we want to make sure is in place first before we recommend whole life?
Yeah, so oftentimes when we sit down with clients, we're talking about education goals for their children or getting to a point where they can be financially independent at a certain age. So there are vehicles to help achieve those goals before we worry about different types of insurance products. So I would say from our standpoint, our professional opinion, generally speaking, we want to make sure that every death benefit is covered by term insurance first until we're able to do the following things. We need to make sure that we're maxing out Roth IRAs or backdoor Roth IRAs if applicable to your situation. We want to make sure that you're maxing out your Roth 401k or Roth 403b. The annual deferral limit is $22,500 for 2023. Want to make sure that you're funding HSAs if you're on a health savings account, if you're on a high deductible health plan. Make sure that you're contributing to your 529s if education's a goal. Make sure that your taxable investment account contributions are on track for your desired financial independence retirement age. If all of those boxes are checked, then whole life insurance can fit into your plan for all the reasons that we mentioned. For it's asset protected. There are ways to access money when the market's down, to have lifelong coverage, to add long-term care protection. So there's a lot of benefits to whole life. I think our issue is that it's not necessarily an issue. we don't have an issue with whole life insurance, the product. We have an issue with where it comes in the order of operations. So
could not be better said. Yeah, it should not be the first place you put money. So we want to make sure financial independence is on track. We want to make sure education's on track if that's a goal. We want to make sure all these goals are all these things are covered first. And then if we think about, again, we'll use this $500,000 physician family example. They're going to be able to max all of those accounts out, and then they're still going to be saving money.
Right.
So if we think about a Roth, a 401k, $20,500, maybe you can do a mega backdoor Roth, do some more. If you're doing that, then you do the backdoor Roth. It's $13,000 for you and your spouse, and then at that point, maybe you've done the HSA, maybe you've done 529 plans. If you're still going to be able to save money, that's going to go into a non-qualified investment account. Non-qualified investment account is great because you are able to access it anytime. It's not tied up till retirement. The downside is it's not super tax efficient. You're paying capital gains taxes on growth. And if you hold fixed income inside of that account, if you hold a government bond, a municipal bond, you avoid federal taxes. If you hold a corporate bond, however, any of the interest kicked off, you're paying tax on. So whole life insurance grows tax deferred. So you could basically, that is a good substitute for bonds inside of a non-qualified account for tax efficiency. However, if you're not doing those other things and you're not accumulating money into the non-qualified account, then it doesn't make a lot of sense. Actually, another funny side note, at the prior place we were, I remember this agent had recommended whole life insurance. The client bought it, and then he wanted to get rid of it because like income changed or whatever. And so the agent, like I was talking to him about it, and he was like, well, remember why we did this in the first place? Like he wants safe money outside of the market. And I was like, well, this specific individual doesn't have any money in the market. Like he's not funding Roth IRAs. He's not funding a 401k. I was like, so like, what are we having this conversation
I think
for?
that's the big disconnect that I see in this oftentimes is that Roth IRAs can be invested in 100% equities. It's stuff we're not touching for a really long time. Generally speaking, the S&P 500 has averaged 10% return in the last 10 years. I mean, we want to
the last 100 years,
last 100
10 and a
years,
half, yeah.
10 and a half.
With dividends reinvested.
With dividends reinvested. So comparing your Roth IRAs returns, your Roth 401k returns, your general investment account returns, those are going to, generally speaking, outpace a whole life insurance contract. So like you said, we want to make sure that they have money in retirement before we start worrying about what happens when the market goes down in retirement. While it's an important conversation, they need to actually make sure that they have the nest egg built up first before we worry about the distribution strategy for that nest egg.
Yeah. So basically, from a high-level recap, a young family for risk management planning should make sure death benefit first, tax-favored accounts, all goals are on track, and then we could fund whole life. Should not be what we're leading with, unless they have a ton of, we may be sitting down with the client and they're making a lot of money, their expenses are low, and we can do all of those things at one time. Mm-hmm. That's fine, but we want to make sure they're able to do all those things before we would recommend that. I think that's a pretty good overview of disability and life insurance. Ben, anything else to add?
No, I would say, again, from a risk management standpoint, there's just a lot of products out there. Even we didn't even scratch the surface with the different types of life insurance, the business applications for life insurance, the other various life insurance products that are out there. I think high level, the two main that you're going to see are term insurance and whole life insurance. And it's not necessarily one versus the other. It's thinking about it in terms of what is the order of what is most important for me and my family? What are my goals? What do I want to accumulate towards? And then making sure that we're prioritizing what accounts and what products can help get us there in the right order. I think that's the most important thing to think about.
Yeah, I couldn't agree more. Well, thanks for joining, Ben. I know you're really an expert in this space on the high income earning young families, a lot of who you work with. So thanks for joining, and stay tuned for next week's episode.
Thanks for having me.
Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.